सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूना सर्वतश्चन नान्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you. Good evening, friends. Welcome to this second day of this income tax corporate taxation relearn series organized by Direct Tax Committee of WRC of ICI. Being chairman of Direct Tax Committee, it's a privilege and pleasure to address all of you. And friends, we are organizing one program on representation before appellate tribunal. Kindly go through all the programs and initiatives which are taken up by the entire WRC team on the ICI WRC portal. Also, I request you to go through the newsletter of WRC, which is being published every month in soft form. So you will be aware about various initiatives being taken by the WRC. Let me mention a couple of them. We have rolled out some plan called something called as My Role at WIRC. My Role at WRC is an initiative to involve all the general members into the WRC's activity. So if you want to become a coordinator, you want to become a speaker, you want to become, writer, you can come forward and contact any of the council members. We'll be more than happy to involve you into the WRC's activity. One more initiative which is very, very close to my heart and which is very important is the networking zone. So, young and dynamic chairman Arpit J. Kabra has introduced this networking zone. We keep talking about networking and we meet people into the various program in physical mode or in the webinar mode. And we say that networking hona chahiye and let's try and build, large firms. That's the vision of our Prime Minister also. But how to put it into concrete action? So here is a plan, networking zone. If anyone, any firm wants to, increase their base geographically, can give an one-liner advertisement which is printed free of cost, just without any name, just the telephone number, just the mobile number is given. With that, we have seen in last 3 months various kind of advertisement which says that the partners are required at Pune, Mumbai, Bangalore, Surat, XYZ, or we have requirements saying that partners are required in international tax, direct tax, GST, the bank for bank audits. We also have advertisements saying that I am interested in becoming partner into any firm and I am expert in GST or expert into RERA or expert into XYZ. There are various forms of advertisement which are helping the members to grow unorganically. Also, the members are able to do the merger alliances. There are firms which are getting sold. In the last month newsletter, there was one last line saying that there is a firm up for sale at Surat. Out of my curiosity, I just called up that firm and said that what are the terms, condition, and I am also interested in this purchasing of your firm. So he said, sir, you are late. The day we posted this, the firm got sold. So there are transactions which are happening because of this networking zone at the WRC's newsletter. There are various initiatives which are being taken. There's one program called Prerna, especially designed for female chartered accountant, which will be sort of a firm's catalyst to the CA firms, and they will, able to work as a consultant to CA firm. One beautifully designed program. Also, we have Wednesday Wow series where the program speakers are all women, the coordinators are women. Of course, the attendee can be male, women, any chartered accountant, and these are the program. Thursday we have something called Package Day. So we have some topic on technology. Friday we have something called Friday Funda. which is again, different from all the aspects of throughout the week, the kind of program we have dealt. We have been getting very good response with various sort of concepts being introduced by the dynamic chairman. Myriad series is one of them, wherein we have been, trying and keeping the seminars for the opportunities available for practicing chartered accountant in the various global market. We have kept the seminars for the something called Doha, Middle East, in the Dubai, Qatar. We have, some opportunities in US, the program opportunities in Australia, so on and so forth. So we request all the members to come forward and attend all the program and be active into this program. Let me thanks Bijal madam for readily agreeing for this today's second session. Very, very important section 28 for, or we talk of 43 CA, or we talk of series of section in 40s. We are in the mid of filing the corporate tax return. We must be doing, audit and tax audit and working upon the corporate tax return. And this is very, very important for all the practitioners. We keep coming across some practical issues when we actually work, and that time we need some support. We need somebody to give his second opinion on the queries, and with that objective we had done one Relearn search series in the month of July, wherein non-corporate taxation issues were handled, the individual partnership firm and all those, and that was again 4 day series. So this is 3 day series and we are in the second day. So once again, welcome to all of you to the second day. I'll request our coordinator CA Vartika Jain to formally introduce Bijal Madam to this gathering. Over to you, Vartika.
Thank you. With a professional experience of more than 2 decades, CA Bijal Desai has advised several Indian and multinational entities on a variety of domestic and international tax related matters. Bijal also specializes in corporate tax research and analysis. Bijal's profile involves dealing with diverse and complex corporate and international tax issues. Bijal regularly contributes articles in professional journal and is a regular speaker at professional forums and seminars.
Thank you, Vartika. And we welcome the Bijal Desai Madam, and ma'am, really thankful to you for sparing your valuable time and coming over as a speaker and taking this very, very important topic for the day on corporate taxation. So over to you, madam.
My pleasure, Ketan bhai. Thank you, everyone. Thanks, Vartika, for introducing me. Just before I start, I can tell you, Ketan bhai, while you are telling me thanks, I have to tell you I have to thank you and all the participants, because it was again an experience of learning for me even before I come to the session. And of course, I'm sure I'll learn a lot from this session. So it is my pleasure and my benefit completely.
Thank you.
So let's start, friends. Business income has always been evergreen for all of us, and every client, every matter that, or every discussion that we are having, we cannot be away from business income provisions. So I think today's session, as Ketan bhai said, will be very important from our practical standpoint, because we are going to, right now we are in a phase of filing returns, closing tax audit reports and all. So I think this is as we call it, it is a relearn series. So we are going back to the days when we were learning section 28, when we were learning the provisions of section 40. So as a chartered accountant, we keep learning, and this is a part of our learning. Uh, so the session will focus on certain provisions which are very, very relevant from a return filing point of view, and that is why we have selected only a few of them, and not everything starting from 28 to the end of profits and gains sections. Before we proceed on to the presentation and the discussion deeper into all of these provisions, let me take you through the scheme of the act. As you know, the scheme of the act is, you have section 28, which is the beginning of profits and gains. You have section 29, which is actually dealing with all the deductions, and it is very often that we forget section 29, and 29 is actually the mother of all the deductions that are available to us. After you look at 29, you have a series of sections which deal with all the deductions. You have section 36, which has a list of specific deductions, and you have one general section, which is section 37. We are not dealing with specific deductions today, we are dealing with section 37 because in most of the cases the issue is always, oh, this is not specified anywhere from 20, anywhere from 30 to 36, so where do I go? And if I go to 37 1, am I eligible for a deduction? So that is the question, and that's why, that's the focus for today. You have 38, 39 dealing with some deductions. Again, when you come to section 40 and 48, they are the ones who are the spoil sports. They are not allowing you this deductions for certain particular payments, or particular entities are not allowed deductions. Then you come to section 41, which is even beyond section 28, because it has something which is chargeable, even though you may believe it is not chargeable to tax, as per not chargeable to tax under the head profits and gains of business. And then you have all special provisions sections starting from 42 to 44 dB. And some of these we will be dealing with because they will be often dealt with by us in, even in common clients and not in specific sector clients. So that's why we've selected these sections after thinking a lot. Starting with section 28, and we all know, what does 28 cover, but let's recap and join some dots if we have some gaps in between, in terms of our understanding. So section 28 starts with 28.1 is covering profits and gains of any business or profession. Now, when you call profits and gains of any business or profession, it's very interesting to note that if you have ever seen, there is no deduction for closing stock. Have you ever thought whether there was ever a deduction for closing stock in our act? Then why do we take a deduction for closing stock every year? How are we able to take a deduction? It's very simple. It's as per section 28.1, because 28.1 says profits and gains from business. And when I say profits and gains from business, my starting point has to be my P&L account. And that is the reason I'm able to take the starting point as my P&L account, the profits as per P&L account, and then I make the adjustments as per the provisions of the Act, which are specific. But the general provision of the Act is section 28.1, and that is the reason my accounts, my books of account, or my P&L account are all relevant from a computation of income point of view. So therefore 28.1 is the mother of the business income provisions, and 28.1 is the one which attracts our P&L account into the Income Tax Act. So that is the basis for 28.1. Now, why is 28.1 further relevant? Because every income which has any connection with your business or profession, or which forms part of profits or gains of your business or profession, all those incomes will fall within 28.1, and there is no doubt on it. You have a long jurisprudence. We'll come to some of these issues little bit in more detail, but you have a long jurisprudence on what can be called as business profits, what cannot be called as business profits, what is incidental to the business, what is ancillary to the business, what is inextricably linked with the business. All of that becomes relevant when we are deciding if a particular receipt is actually a profits and gains of any business or profession. After that, you have compensation. You have compensation for termination or modification of terms. Now, there are various compensations which have been listed in the subsection 2 of section 28, and one of them relates to the management agency. The other relates to a manager who is managing the business of an entity in India, of a foreign entity in India. There is another section which say, I mean, sorry, there's another clause in subsection 2 which deals with compensation received by a manager for managing an Indian company. So these are all compensations which are covered in section 28. But what is more relevant for us and more generic is this, is the compensation which is in relation to any contract or relating to a business. Not just any contract relating to a business. Of course, it has to be a compensation. I'm sorry. Of course, it has to be a compensation for termination or modification of the terms of a contract which are relating to the business. So now, if you have a contract with a supplier, and a contract with the supplier for 1 year, and there is a closure of that contract, and for that closure, if a business receives some compensation, then that compensation is covered under section 28. Earlier, when this was not there, people used to argue that, look, these are compensations which are capital in nature. These are capital receipts, so they are not taxable. So there was a host of high court decisions which was dealing with such kind of compensation. Some of them, there were some a couple of Supreme Courts also dealing with compensations in connection with termination or modification of the terms of a contract relating to the business. Now, when and these the jurisprudence was saying that these are all capital receipts in nature. In most cases, it was saying that, and since it is capital receipt in nature, it is not taxable. And with that, the amendment came in, I think, around in the Finance Act 2017, when they brought this into the act, and they ensured that any compensation that you receive for a termination or modification of your terms, which are terms in a contract which is directly related to the business, it will be covered. So it can be any kind of a termination or even modification. So keep in mind that even a modification of terms of a contract gets covered. If you receive a compensation, then that compensation is covered in business policy. The same was the case with non-compete fees. In case of non-compete fees, what used to happen is, obviously, by its very nature, somebody could have easily argued that this non-compete fees is not my business income, because I am coming out of the business and I'm only promising that I will not share the secrets of the business, I will not share the know-how of the business, and so on and so forth. And that was non-compete. Or maybe I will not go into the competing business is also probably, one of the kinds of compensation that is received. Now, such compensations which were received, again, there is a jurisprudence where courts were saying non-compete fees is capital receipt in nature, and since it is capital receipt in nature, it is not taxable at all under the act. Section 4 also does not apply. What happened is, there was an amendment. Now, this is a very a pretty old amendment, maybe 15 16 years ago, when non-compete fees was brought into the tax net, and it was clear that this will become a part of section 28 itself. So 28(5)(a) covers non-compete fees as well. Now, if you look at benefits and perquisites, benefits and perquisites has now become a very hot topic. And you know why I'm saying it's become a hot topic? Because of Section 194R, which came in the last in Finance Act 2022, and that has brought youth to the Section 28(4). And we will talk much about section 28(4) in our discussion, because that's become more relevant than now than ever, even though there has not been any extraordinary amendment in it. Of course, there has been an amendment in 2023, but it had become relevant from last year itself. Conversion of inventory into capital asset. Earlier, what used to happen is, there used to be a conversion, but people were not taking the right cost of acquisition for the inventory. So now they are very clearly having a provision into the act, where conversion of an inventory into capital asset has been taken into consideration, and the FMV of the inventory on the date of conversion is being taken into consideration for the purposes of the business profits. So friends, as you know, I have explained, Section 28 is becoming more and more comprehensive. I have kept the partnership related provisions out, because they are a topic in itself. And, as I understand, this is for corporate SSEs that we are talking. So we don't need to discuss the provisions which are related to the partners and partnership firms. So here today we are going to deal purely in relation to corporate SSEs. Okay, so as I said, Section 28 is becoming more and more comprehensive. More and more things are getting added to it. And very important to know that, when I talk about this compensation for termination or modification of terms, if you see in the Act, you have Section 224, which is the definition of income, And every time an amendment comes, or every time an introduction is made about a particular payment in section 28, there is a corresponding amendment in section 224 as well. So if you would have noticed, section 224, the definition of income also covers non-compete fees. I mean, it covers 28 5A, Roman 5A, clause 5A. It covers 28.4, I mean, clause 4 of section 28. It covers compensation, clause 2 of section 28. All of these are covered. So, if there would have been an SSE who would have said these are capital receipts not taxable, even though they are covered under section 28, since they are not specifically covered under income, I will not pay tax on it. That argument goes out of the window. It is very clear. It is added to the income. Even if you believe it is not an income, it will be deemed to be an income, and it will be treated as business profits. And yes, of course, you get deductions for all the deductions with respect to these payments as well, if you have any eligible deductions from section 30 to 37. Now, coming into a little bit of nitty gritties on section 28 and some interesting points to note. uh, as I said, capital versus revenue has always been the fight for every payment which is different from from your ordinary profits and gains. So it's very relevant that any income, or rather any receipt that is being that you are put under consideration, you will have to think whether it's a capital receipt. If no, if it's a revenue receipt, then the next question is whether it is related to your business. If it is relating to your business, or if it can be considered as a profit or gain. Now, it's not just profits, because profits may be something which is from direct business. Gains may be something which is even incidental. And those gains, so any receipt that you receive as a part of your business operations or in the ordinary course of your business has been read very widely by courts. So it may not be possible in most cases, I would say, where you have a genuine business, to argue that certain there is no business in existence. All those arguments will not be possible when you really have a business in existence. Those arguments may be possible when there is only one isolated transaction, or a couple of stray transactions are there. Only in such cases you will be able to argue there is no business. However, otherwise you won't be able to argue that there is no business. So therefore, what is relevant is you will have to see if a receipt is capital in nature. If a receipt is capital in nature, it should not get covered unless it is specifically covered under section 28 in any of these items. So if it is not covered in any of these items, then even if it is a receipt in which is springing out of the business of the taxpayer, even then you may say that it is not taxable, because your income definition does not cover any capital receipt. It only covers revenue receipts, and therefore your section 4 also does not cover section 4 of the income tax act. So the charge of tax itself is not there on capital receipts unless it is specified in the act. Now, before we move on to this point, I would just like you to, pay attention a little bit to the section 28 language, so that when we proceed, it will be quite helpful for us to keep in mind. So what does 28 say? The following income shall be chargeable to income tax under the head profits and gains of business or profession. Clause 1 says the profits and gains of any business or profession. So it's very important. You need to have profits and gains. Second is very important. You need to have a business or profession. And third is which was carried on by the assessee. So the assessee has to carry on that business. If I am an employee of an organization, my income cannot be a business income, even if it erupts from that business, because I am not carrying on that business. And while it may sound very simple, in certain practical cases, this issue has also arisen whether that person was carrying on business, or whether the agent was carrying on the business, or the principal was carrying on the business. And that is the reason this issue also becomes very important. At any time during the previous year, now this is very important. At any time during the previous year means during the previous year have been carried on. So if the business was not in existence, meaning pre-incorporation or post closure of the business, all these periods are the periods when the business is actually not carried on. And any incomes which are earned before the business comes into existence or after the business is closed down. What happens to those incomes? You will have to think over, and there is a list of jurisprudence on it. There's a whole host of judicial precedents on this for pre-incorporation also. In fact, the courts are divided, and we'll come to it. There is a host of jurisprudence on, after closure of business, whether a particular receipt can be treated as business income, uh, so on and so forth. And there again, there the courts are divided. But fundamentally, I think all of us need to keep in mind that the section is very clear that unless you have a business which is carried on during the previous year, there cannot be a profits and gains from business unless it is specifically given in a particular section like 41. 41 does say it, you know. So 41 is a different section. At least from 28 point of view, it won't be covered. Now, when you look at section 28 and the other heads of income, so business versus employment, what happens is, uh, while it may sound very obvious, oh, employment means I would have received salary. Where is the question that it is a business? But in certain cases, it's not very clear. The terms of the arrangement are not so clear to say that they are of a nature where they give rise to a master and servant relationship. So, it is as simple as let's say a chartered accountant who is ready to be a service provider, and one company, one organization, ask the chartered accountant that, look, you have to be exclusive for me. I don't want you to work on any other client. I am taking your retainership services. Now here it becomes the line becomes very blur as to whether it is a business of the chartered accountant or it is the employment of the chartered accountant. Of course, the terms of the arrangement will be the ones that will be ruling the game. And what will you look at into the terms of the arrangement? What you have to really look at is the person working under the instructions of that person? In that case, if he's working under the instructions and if everything is being managed by that person, or all his actions are being controlled by the principal, then that principal becomes an employer. It could be other way around. It could be a principal to principal relationship where, yes, there is some assignment which is given to the chartered accountant, but he is doing his job on his own. And let me tell you, it will not be simple in any of these cases. And ultimately you will have to uh, decide on one way or the other and be consistent about it. So maybe that is the practical approach that you can follow in certain cases where it is very difficult factually to come to a conclusion if it is a business or if it is an employment. Business, when I say business, it is obviously interchangeable with the word profession, because at the moment we are using business as a common term for business as well as profession. So there are these decisions which I have listed here, which actually deal with the terms of arrangement in those particular facts of the cases, and they have decided one way or the other in each of these cases based on the arrangement. Now coming to business versus capital gains, and here, so what happens in business? Where is the situation, or what is the situation in which you face this issue? The most common situation is dealing in shares. So if I am employed with one employer, but I'm still doing or dealing in shares. Now when I am dealing in shares, it is possible that I'm dealing very often, meaning on a daily basis I'm dealing with shares. Would you call my dealings in shares as a business, or you will call that these dealings are investments in nature, they are capital, and the income from there should be capital gains in nature? What becomes very important here is again the intention of the taxpayer. What was the intention of the taxpayer at the time when he was investing, or when he was actually buying those shares, or when he was actually getting into the transactions for these shares? Again, as I told you before, it will be easy said than done to apply the criterion, or the criteria which have been laid down to decide whether it is a business income or a capital gains. In certain cases it might be very easy, in certain cases it will become really difficult, and what will best help us is to apply one stand and continue with it consistently and not change it. And that is what even CBDT circular number 6 of 2016 says, that if in case of public companies, publicly listed companies, if you're dealing in that And if the taxpayer believes it is a business, he should treat it as a business income, treat those shares as a stock in trade, and and show it as a business income. If the taxpayer believes it's capital gains, let him do it, but let him be consistent with it. That is what 2016 circular says. And 2007 circular, the circular number 4, which is there on this, which has been listed on the screen, actually lays down so many criteria to decide as to whether the income is a business income or a capital gains. And it has listed down some n number of things there. Not all of them also can be treated as a conclusive list for deciding whether it is business or capital gains, but it is a good guidance. While it is a guidance given to the assessing officer, we can also apply it, and probably the department should be okay if we apply that and come to a conclusion. There are some of these decisions which have, taken different stands, and have been uh, you know giving views based on the facts of each of these cases. Like for example, in Simpson, there was a land which was sold. Now the question was, when I'm selling the land, can I call it as a capital gain, or is it supposed to be my business income? And the court checked into the facts. It came to a conclusion that, look, this land was not a stock in trade for the business. If it was not stock in trade, then it is capital gains. In another case, what happened is, in that heritage estate case, mm, the memorandum and the articles of association, they were saying that the business can deal with immovable properties also. So the assessee was arguing that when I sell the immovable property, it should result in a business income, because my MOI and AOI also cover it. Court said nothing doing. It is not a business income because you are not dealing with these properties as such as stock in trade. So while your memorandum, while your articles of association could be good evidences for proving as to what is your business, actual conduct of business cannot be ruled by them. Whatever is the actual conduct of business, when you're really uh, not considering any of these capital assets as a part of your stock in trade, then how will the court be, how will the court be agreeing to a proposition saying that this is business income? In another case, in Afonso, what had happened is, in the partnership deed itself. Now, partnership deed is obviously a little bit on a higher footing than the memorandum of association. And since in that partnership deed, it was very clear that the partnership can deal with agricultural properties also, and it can do purchase and sale. And they obviously saw that it was a part of the stock in trade, which is why they gave a view that in this case it can be a business income. So what I said is that what is very important in considering whether it is a business income or capital gains is the intention of the taxpayer in entering into the transaction. Now, what happens to business income versus other sources? Now, when I say business income versus other sources, what could be coming to our minds is basically interest income. Dividend income, we will never have an issue because dividends are specifically covered in 56(2), as a part of 56(2). So, ordinarily, you will have to I'm sorry. Ordinarily, you will have to offer dividends as other sources. There is one school of thought which believes that if dividends are directly related to my business, coming out of investments which are stock in trade, they should be treated as business income. And there are some tribunal and high court decisions in the favor of this view also. But still, a better view, in my personal view, should be that it should be treated as other sources. So we are not covering dividend here. We are covering interest incomes, and interest incomes can be various. It can be coming in different forms in a business, because commercially, every time there is a delay in payment of something, there can be an interest income, or every time there is some advance which is given, there can be an interest involved. So what could be the characterizations possible for an interest income? One is, it can be capitalized. Capitalized means uh, you reduce it from the cost of acquisition of a particular capital asset, or you reduce it from the capital expenditure that you're doing for expansion of the business, or you're setting up a business and you're paying interest income for the loan taken for setting up of the business, then that is supposed to be capitalized. Capitalized meaning you reduce it from the capital expenditure or you reduce it from the cost of acquisition of the asset that you have purchased. Second possible treatment of interest income is you treat it as a normal business income, treat it as profits and gains, and cover it in section 28. Third possibility is that it is not related to business. You are not able to demonstrate that it is a part of the business or profits and gains of business, and therefore it is other sources. And when you say it is other sources, it will definitely not be eligible for the deductions that are available from a business point of view. And that is why normally people are inclined to cover it in the business income. Of course, the facts will rule the game, but in general, there is a preference to cover it in business income because you have a possibility of reducing unobserved depreciation, brought forward losses, and everything from such increase. Now let's deal with some of the type of the interest incomes. Interest on FD from excess funds or surplus funds. What happens to interest on the fixed deposits? Now, what happens is this is a very common phenomena that when the business has excess funds, the business will invest it into fixed deposits to ensure that it is getting some returns out of it, and if it has some interest to pay, obviously the money has to obviously the interest which will be earned has to compensate for that payment of interest. Now, what do you call the interest on FDs? And if you see, there are a host of judicial precedents on this. Some of them on the side to say that they are business incomes only. Some of them on the side to say that look, excess funds, you're just investing into fixed deposits. There is nothing that has a connection with the business. And because it does not have a connection with business, it is other sources. There are others who say, look, these are funds which I took for business. And if they are funds which I took for business and there is a surplus out of this, obviously I will keep them into a fixed deposit to ensure that the money earns interest on it. And therefore, it should be business income. So, both ways you have jurisprudence. uh, a, uh, Probably a more inclined view is to take it as other sources, but if the client is anyway into a litigation for various other matters, and if it is preferable for the client to go by business income characterization, and you're able to demonstrate at least to some extent that these are funds which were taken for the purpose of business, and therefore if there is a surplus and which is invested into fixed deposits, that should be treated as business income. I think it should be possible to make that argument unless the client is really averse to litigation. Now, coming to interest on fixed deposit to secure a bank guarantee to acquire contract work. Now, there was a high court which was dealing with these facts of the case, and since it was a fixed deposit that was mandatory to be kept to secure a bank guarantee, and that was obviously directly related to the acquisition of a work for the business purposes, then any interest on such kind of fixed deposits should be treated as section 28 income, and should be treated as profits and gains from business. Again, interest on margin money to obtain business license is having the same fate because margin money to obtain business license has a direct connection with the business, and because this margin money has a direct connection with business, any interest on it should be treated as profits and gains from business. Now, interest which is received before setup of business, many a times, and this is very common fact pattern, that before the business is set up, you have some funds coming in. You also have your share capital. In fact, share capital, loan, all of these are steps which are taken before the business is set up. And you have money. The moment money comes into the business, you are not going to keep it idle. You are going to invest it into at least fixed deposits. So when the company invests it into fixed deposits, but the setup date is a little later, what happens to this interest received? As I said, and this is the reason I was discussing Section 28, that for Section 28 purposes, you need to have a business carried on by the SSE at any time during the previous year. If you are looking at interest received before setup of business, is it an interest received for the business carried on by the SSE at any time during the previous year? Number one, there is no business. Number two, it may or may not be in the same previous year. If it is in the same previous year, you are not fulfilling the condition of the existence of the business. So therefore, interest received will be treated as other sources. And same was the case, in case of Tuticorin, where the business was not set up, and the Supreme Court said that this will be other sources in nature. There was this case of the Supreme Court in the case of Bokaro Steel. Now, what had happened in Bokaro Steel is that there were some quarters which were formed. So there was a business, there was a setup of a unit, of a plant and machinery unit by the assessee even before the business had started. And that setup, for that setup, there were some quarters which were prepared, cottages which were prepared for the construction work, and there was a rent income which was received from those that construction work. The question was whether you call it as a whether you call it, whether you will offer it to tax for income as other sources. There was no question of whether it was business income or not, but there was a question whether you will treat it as other sources or you will reduce it from the capital expenditure. Many a times this kind of scenario also comes into existence. Our first instinct goes to say that this has business income nature, but actually there was no business in existence in such facts. And when there is no business in existence, there is no question of a business income. The only question is whether you should treat it as other sources or you should capitalize it. Capitalize means reduce it from the capital expenditure. In that case, the court said because it is inextricably linked to the expansion activities or the setting up of activities of the business, it has to be reduced from the capital expenditure. So there were some 3 or 4 payments which the court was dealing, and the court had applied this principle for each of these payments. What happens to interest on income tax refund? In no probability it can be treated as business income. It has to be treated as a other sources income, and you will have to offer it to tax accordingly. What happens to subleasing of premises? And surprisingly, there are some high courts which are saying that, in a fact pattern where the assessee argues that I had taken a business premises on lease for the conduct of my business activities, and then I am subleasing a part of it. This is a very common fact pattern, and the assessee says I'm subleasing a part of it. The court has somehow agreed that subleasing of those that premises or the part of the business premises which was taken on lease by the assessee is the rent from it is in the nature of business income. Now, this is one court. There is another high court which is saying no, subleasing of premises cannot be treated, the rent from subleasing of premises cannot be treated as business income. It has to go into other sources because the SSE is not in the business of subleasing. So, I think it will be very important to apply the test of what business the SSE is in. And if the income which is coming in the SSE's hands is directly related to that business, then you can call it as a business income. If it has only an incidental connection with the business, then you cannot call it as a business income or profits and gains from business, and you will have to treat it as other sources income. What happens to a commission which is coming from the transferee of the business? What had happened in this case is that there was a business which was transferred by the transferor, and the transferee was giving some commission to the transferor, and the court held that the transferor is still into a business of doing that activity which is yielding him the commission, and which is why it is in the nature of business. So there was a factual, or rather there was a fact finding that there is a business in existence, and because of that the court held that there is a that the commission should be treated as profits or gains from business. We already discussed as to what is the nature of pre-incorporation profits. Pre-incorporation profits clearly are into the zone where the business is not in existence, and if the business is not in existence, clearly you cannot say that those profits are related to business. Now, why this question? This question comes because there is there are at least 5 to 6 cases where the promoters, they said that look, when the company was in the process of incorporation, and when the business was in the process of being set up, we had already started off the business, and there is a lot of profit which has come from that business, so we want to offer it to tax as a part of the profits of the company itself. And more or less the courts are on one lines, except for one or two. The courts are saying that look, pre-incorporation profits means that the profits came into existence or there was a business which was not carried on by the SSE. The SSE took over that business only after the business was set up, only after it was ready to commence business, and only because there was no business in existence in the hands of the company, you cannot say that the profits are of that company. So even if you are transferring those profits, they cannot be taxed in the hands of the company. They have to be taxed in the hands of the person who was carrying on that business, and he cannot be said to be carrying on the business on behalf of the company because the company was never having the business. So that is what the courts have said, and I think that is in the correct technical lines, because unless and until you have a business in existence, there cannot be a section 28 income. Business loss. Now, why does this form part of section 28 and why not section 37? There's a yeah, a lot of debate on whether a business loss, for example, a foreign exchange loss, whether a business loss can be treated as a loss, or rather, it can be treated as an expenditure, which is allowed under section 37, or it is supposed to be allowed under any other provision of the act. And the point is, section 28, when it says profits or gains from a business or profession, it obviously covers a loss. So when I say I have incurred a foreign exchange loss in my business, then that foreign exchange loss has to form part of section 28 itself. It has nothing to do with an expenditure, because 37 and the other sections which are dealing with the expenditures are all dealing with expenditure incurred, expense incurred. And loss is not an expense incurred. Loss is a loss which has been incurred as a result of it. Can be an embezzlement of cash. Somebody is stealing the cash uh, from your shop. What happens to that loss? Is it an expenditure? Answer is no. There is no expenditure, but it's a loss. And where does this loss get accounted for, or where does this fall? It falls within section 28 itself. It cannot go into any other section. So when there is a loss, don't get we don't need to get panicked that, oh, where is the enabling section? There is enabling section, section 28, and you have a host of Supreme Court decisions dealing with these kind of losses, which have very clearly said that anything which is a business loss in nature may not get covered in 37(1) specifically, but they are covered in section 28 itself. Now coming to section 28(4), we just discussed that this has become a very hot topic now, and especially 194R has become a hot topic, and by the way, section 28(4) has also become very hot because of this reason. Now, what is so peculiar about this section? Was this section, or rather, has this clause been inserted into the act recently? Answer is no. It was there in the act since 1964. Since 1964, it has been in the act. Since 1964, there have been courts who have been dealing with this provision in various kinds of receipts or benefits received or transactions by the companies or SSEs. A lot of things have been discussed on 28(4), but why didn't it have that much limelight until now? The answer is because now you have section 194R, which has probably become quite onerous on many taxpayers, where the taxpayers are required to deduct tax on any benefit which is being provided to any other person. And the concept of benefit, as we had understood before 194R, has changed altogether after the section 194R coming in, because of the CBDT circulars, because of the explanations being given um, by the people from the tax authority side. Now, has 28(4) undergone any change very recently? Answer is yes, only to some extent. So its main language or its main section has the same, or main provision is still continuing to be same. There has not been any substantial change for that matter, except for the cash benefits related change. So let's go through the section. What does it specifically cover? So 28(4), as it reads, is the value of any benefit or perquisite. arising from business or the exercise of a profession. Before the amendment, recent amendment in Finance Act 2023, it read as um, whether convertible into money or not. Full stop. And now, there is something which has been added, and we'll talk about what has been added also. So, what is relevant here? Arising from business? Sorry. First, what is relevant is benefit or perquisite. Only if the business receives, or rather, only if the assessee receives a benefit or perquisite which arises to him from the business or the exercise of a profession, whether it is convertible into money or not, it will be treated as business profits under section 28(4). And what was the intention of this clause 4 when it was inserted way back in 1964? If you look at the memorandum or the circular which was dealing with the provisions of the which was dealing with the explanation as to why the provisions were introduced, the circular was saying, or the circular says, that it was introduced with the objective of covering the additional benefits that are received by a person while carrying on the business or profession. And the example given is of a lawyer, where if a lawyer is rendering services to his client, and the client uh, is happily uh, is happily granting him a stay of 2 nights in a luxurious hotel, then, and also obviously for his personal benefit, nothing related to the business of the lawyer, then the benefit which is received in the form of a stay in that luxurious hotel should be taxed under 28(4). This is what the memorandum says. Now, leaving apart the fact that whether that memorandum uh, or whether the language in the memorandum is in sync with the language of 28(4), leaving that apart, if this was the objective, then what it really meant is that you wanted to cover any benefit or perquisite which is being received by the professional, the lawyer, in the course of his business or profession, or because he has rendered a particular uh, service in the course of his business or profession. That was the objective. And in ordinary sense, the lawyer would have not considered the value of the stay, or the amount equivalent to the payment that he would have had to make for the stay in that luxurious hotel. He wouldn't have put that money into his books of account as revenue, and that is the reason there was a need for section 24. Now, having said that, now what we are seeing is a host of other things which are entering it into this 28(4) because of, or by way of, a root of section 194R. And I think it is very important to discuss as to the interplay of 194R and 28(4). So before this amendment, what we used to believe is the language is whether convertible into money or not. And there were Supreme Court decisions which were to the effect that if there is a monetary benefit, it should not get covered under 28(4), including the case of Mahindra and Mahindra, where it says, whether convertible into money or not means it should not be actual money. So when it is not money in nature, or when it is not cash in nature, only then it will be covered in 28(4). If it is cash in nature, 28(4) does not cover it. And obviously there is uh, a bigger condition that even if you receive something as a benefit of a it has to arise from business or profession. Now, when you come to section 194R, which I've been talking about all this along, it also has the same language which I read for 28(4). And it says, a tax is required to be deducted from the value of the benefit or perquisite which has been provided to a person, and it arises to that person from his business or profession. So the language is exactly identical to section 28(4) for 194R purposes. And 194R was introduced just in Finance Act 22, as I said. Now, what is the implication of 194R on 28(4)? Basically, I would have said it is other way around. 28(4) should have an implication on 194R. So whatever I believed was getting covered in 28.4 until last year will also now get covered in 194R, which is fair, reasonable, that a tax reduction is required on. Now, what has come and what I believe will become a little onerous for the taxpayers is the list of things which have been covered in the CBDT circulars which have come after the introduction of 194R in the last year. So, circular number 12 of 22 and 18 of 22, they cover all the things that are intended to be covered or that should be covered under 194R as per the CBDT. And it covers a host of things where if you apply the test of uh, of a monetary benefit or you apply the test of arising from business, not in all cases that test gets fulfilled. Even then, the circular says 194R will apply to those cases. So then, because the circular is a part of 194R2 or 194R3, it it should form part of the law, and therefore it does not have the same standing as 119 circular. It is a little bit on a different footing. Now the question is, will those circulars have the or will the items that do not fulfill the conditions of benefits or perquisites arising from business, but treated as a part of section 194R in the circular, will they also attract 28.4 now going forward? My personal view is that answer is it should not be so, because the circular itself says that 194R is only a deduction section, and whatever is stated in the circular does not mean that it should be taxable in the hands of the recipient. It may or may not be taxable. So when I'm looking at 28.4, it is obviously from the recipient's point of view. When I'm looking at 194R, I'm advising the payer or I'm advising the provider of the benefit. When I'm advising the recipient of the benefit, I will advise based on the strict interpretation of the law in section 28.4. And only if the conditions in 28.4 are fulfilled, I will say that the benefits should attract some taxation in the hands of the recipient. So now, what do you call as a benefit? Number one, benefit is any advantage that a business receives. This is pretty wide. What do you call as an advantage? When I'm entering into a contract with somebody, and if somebody gives me a fee, is it an advantage? Answer is no. It is a transaction. It is a transaction where I am promising something, somebody else promises something, so it should not be treated as an advantage. An advantage is something which is over and above, generally something which is over and above what I may call it as enforceable. Because whatever is enforceable is obviously a part of the transaction. It will be very difficult to say that it is falling within the meaning of benefit or a perquisite. Perquisite has to be something over and above what I'm supposed to receive in the general sense of it. And we cannot import the meaning of perquisite from section 17, because 17 has a different meaning of perquisite altogether. And let's not forget, it is an artificial meaning given to it. So perquisite obviously is something which is over and above. I can say, when I'm having a bungalow in Lonavala, I have the perquisite of having a view of the river besides. Now that can be treated as a perquisite, that while I'm staying in the bungalow, I'm able to see the view of the river. But in general, when something is a part of that bungalow, that cannot be treated as a benefit because I've bought it. It will be my, I would have paid money for it. So, having said that, in practical situations, it could be very difficult to come to a conclusion whether something is a benefit or purpose. It will be an easier test to check whether something arises from business. Why? So, in many cases, what you will have to do is, okay, let's presume it's a benefit of opposite, and move ahead and check if it is actually arising from business. And if it actually arises from business, obviously it has to be covered under 28.4 if you believe it's a benefit or perquisite. Now, what will you treat as arising from business? Arising from means something which springs out or which pops out from the business. It is not something which is incidental to the business. So, 28.4 arising from business cannot have the same meaning as profits and gains of business as per 28.1. it is definitely narrow. This is only arising from business. Whereas if you see 28.1, it has a wider language. It says profits and gains of business. So that can also cover certain incomes which are ancillary to the business, or maybe which are they sh- which are even incidental to the business, in to some extent may get covered in the business income. But here in 28.4, only which is directly coming from the business should be covered, and not something which is indirectly coming. Now, this is my personal view, that I'm saying that it should be something directly coming from the business. Having said that, there is a Supreme Court which is in favor of saying that something which only springs out of the business is getting covered under arising from business. Supreme Court, in the case of universal radiators, is the one which talks about arising from business. Coming to whether convertible into money or not, as I said, there were these two Supreme Court decisions which were clearly saying, when the language used is whether convertible into money or not, money actually can't be covered in that provision. So to circumvent that, there was an amendment which was made in Finance Act 2023. This amendment covers all kinds of cash benefits, or all kinds of benefits where the benefit is partly in the form of cash and partly in the form of kind, or fully in the form of cash. So everything is getting covered, whether cash or no, is now getting covered in 28.4. So until last year, and right now you're going to file a return for financial year 22-23. So this amendment does not apply to financial year 22-23. It only applies to the subsequent year where the assessment year is 24-25. So for the return which you want to file now, you can still apply the old law, which does not cover cash receipts, cash benefits, and in certain cases you can take a stand based on the Supreme Court decision, which is the law of the land, that no cash benefits should get covered. Now let's look at some of the interesting points. Well, we already discussed some of them. What happens to the benefits in kind which are received by the doctors? And uh, and it is very common for many of the doctors to receive benefits which are intangible, or rather benefits which are not in the form of cash. They are benefits in the form of free samples of medicines. They are benefits in the form of you know uh, some posters that can help actually the business of the doctor himself. There are huge benefits to surgeons and many other renowned specialists in the form of certain perquisites, maybe some vacations, maybe in the form of some expensive cars. All those kind of benefits are being received by certain doctors from pharma companies, and these benefits clearly would get covered under section 28.4. Whether they are received by the doctors individually, if they are doing their own practice individually, then it will be covered as their profits and gains from profession. If they are a part of some organization where they are employees, then actually that income those benefits will be treated as 28.4 income of the organization, and in the hands of the doctors it will become a section 17 perquisite. So it will be both ways taxation, it will not be just one way taxation. What happens to incentives received by the distributors from manufacturers? Now, this is a very common scenario where distributors receive incentives from the manufacturers, including discounts. Now, what is happening is discounts generally are not benefits, they are not perquisites. Discounts are a part of the commercial negotiation of a trader. Having said that, in the circulars which I was mentioning relating to section 194R, they say that discounts are in the nature of benefits covered in 194R, but they do not want to bring them into tax under 194R. So does that mean that discount should be covered under 28.4? I think one will have to apply the right technical principles. And since discount in general, as we understand them in general sense, are not in the form of a benefit, but they are only in the form of they are only the results of a negotiation between two parties. They should not be treated as benefits, and so that cannot be treated as 28.4. But other incentives which are received by the distributors, in the form of like expensive cars, like expensive vacations, for these people. There are so many times that the manufacturer says that if you reach so and so target, we will give you a vacation to a Europe tour, or we'll give you a 3 night stay at a particular location. All of that will be treated as benefits under 28.4. Now, what happens to freebies which are received by the distributors or the customers? See, when the freebies are received by the distributors, they would generally get covered under 28.4, but it is very important that you look at the terms and conditions of every scheme or every arrangement before you come to a conclusion. Okay, if I am a customer and I receive some freebies, do I receive them in the course of my business, or do they arise to me from my business? Answer is no, and therefore it won't be taxable even if it is a benefit by any chance in my hands. Then gifts received from followers by these babas. Some Let's take an example. If Ramdev Baba receives a gift from one of his followers in the form of a Mercedes car, does it form part of the taxable income of Ramdev Baba? The answer is yes, because there are quotes which have said that these gurus, some of them, uh, when they are giving their preachings, they are actually exercising a vocation. While it may not be a profession in the strict sense of it, it's a vocation and it is covered under business. So because it is covered under business, it can be a 28.4 benefit. uh, Having said that, there is a decision of the Mumbai tribunal, a recent one, in actually this is Nirmala Athavale. And in Nirmala Athavale's case, the tribunal has taken a different position than the Supreme Court's case, maybe in the facts of that case. And now, if you come to waiver of loan, and this is a subject in itself, we will just touch upon it. What does a waiver of loan lead to? Does a waiver of loan lead to a benefit? If the answer is yes, uh, to some extent, I mean, as per one school of thought, it can be a benefit in the hands of the debtor, because the debtor is absolved of his liability to make the payment, make the repayment of loan. And in that sense, there is a benefit in the hands of the debtor. Is it a benefit arising from the business for the debtor? It is disputable. As per one school of thought, any loan is capital in nature, whether or not it is taken for capital assets. Because it is capital in nature, it it should not arise from business, because it is not in the normal course of business that a waiver arises. You are not into a business of taking and giving loans. If you are into the business of taking and giving loans, then a waiver can result into a benefit arising from business. But in an ordinary case where it is not, where the debtor is not in the business of obtaining and giving loans, probably he may be able to argue that it is not arising from business. The other school of thought is that it arises from business, because ultimately a loan was always taken for the purpose of business. And if it was taken for the purpose of business, any waiver should result in a receipt which is also connected to the business directly. So there is a dispute on this. We will have to wait for some jurisprudence on this, a concrete jurisprudence on this. I'm not saying there is none. There is a lot of it, and the courts are divided. The views are divided. Not all aspects have been dealt with in all of them. So you don't have a complete picture in any of these decisions from all the elements point of view. Further, in most of these cases which are dealing with waiver of loan, they were always dealing with the words whether convertible into money or not. And they were saying, okay, by the way, cash receipts are not covered. So if cash receipts are not covered, then 28.4 is out. But now we will have to see, because after the amendment from financial year 22 20, from financial year 23 24 onwards, the new law applies, and all cash receipts, all waiver of loans which will be treated as cash receipts, may be having an exposure under 28.4. And yes, very important, until financial year 22-23, Mahindra and Mahindra is directly applicable. Mahindra and Mahindra Supreme Court decision is directly applicable to a waiver of loan, and so therefore it should not result into a benefit under 28.4. Business gifts, again, what we discussed, you have to apply the same criterion whether these business gifts are actually arising from business, and you will have uh, a, a a wide range of fact patterns. In certain cases, a gift will be received at the wedding of a businessman. In certain cases, a gift will be received because the lawyer has dealt with the litigation matter quite efficiently, quite nicely. So it will be different fact patterns, and you will have to decide on the basis of each fact pattern as to whether a benefit arises. Again, subsidies, whether they are 28.4 or no. And if they are arising from business, they will form part of 28.4. If they are not arising from business, in any case, you have section 224.18, which has been added to the act. So subsidies received from the government will anyway be covered, and so you will have to check the taxability accordingly, whether it falls under 28.1, 28.4, or 56. Now coming to the important uh, deduction section. As I said, we didn't want to deal with 36 today because they are specific deductions. We'll deal with 37, which is the most common provision helpful for a deduction in most of the expenditures. So the first and foremost condition for any deduction is that there has to be an expenditure. There has to be a liability which is incurred. There has to be an expenditure which has been incurred. So, laid out or expended are the relevant words to be kept in mind, which is wholly and exclusively for the purpose of business, is the other condition. It should not be capital expenditure in nature, and it should not be personal expenditure in nature. Personal expenditure is not very relevant for corporate assessee, so we will deal with the other three conditions today. Now, before we come to this, laid out or expended is very important, because in certain cases, you do not fulfill the condition of the expenditure incurred by the assessee. When you don't fulfill the condition of expenditure incurred at all, does it fall under 37(1)? The answer is no. Or maybe expenditure incurred in that previous year is also very relevant, although it is not a part of the language of section 37. Still, it is given that you treat it as an expenditure which has been incurred in that particular year. And let me read out section 37(1) for you to give a perspective. Any expenditure not being expenditure of the nature described in sections 30 to 36 and not being in the nature of capital expenditure or personal expenses of the assessee, laid out or expended wholly and exclusively for the purposes of the business or profession, shall be allowed in computing the income chargeable under the head professional debt. So therefore, very important, it should be wholly and exclusively incurred or laid out for the purposes of the business or profession of the assessee. It should not be capital expenditure in nature. Now, what does this mean? It should be wholly and exclusively for the purpose of business. And this is the term which we have been interpreting or we have been applying to various fact patterns, right? For every particular deduction. And the way the principles will have to be applied. We have all become good at it, but I'm just repeating or recapping of all these principles that we have been applying all throughout. One is the necessity of the expenditure. Is it relevant? Answer is no. I might end up making too much of expenditure on an advertisement of a particular brand. It is nobody who can question me as to the quantum of the expenditure. Why? Because I'm a businessman, it is left up to me whether I want to incur 1 crore of rupees for an advertisement or 10 crores of rupees for the advertisement, irrespective of whether I'm able to afford it or not. If I'm incurring it for the purpose of business, that's the that's the test to be applied. If it is for the purpose of business, it should be allowed. Necessity of the expenditure is not relevant. Motive of the expenditure also is not relevant. And what is the difference between purpose and motive? The purpose could be for the business, motive could be something else. Motive could be a larger motive. So today I'm making some advertisement expenditure for building my brand. Now my motive is, in my mind, the motive is that I will build the brand and I'll sell it off tomorrow. So the brand value will increase because of this expenditure. And then my motive is that 2 years down the line I want to sell this brand, so I want to make it big and I'm able to earn a huge money out of it. Now, what is the motive? The motive is probably capital in nature, because the motive is to earn capital income. However, the purpose is basically to build the brand, and the brand is built for the purpose of the business. Because the purpose is for business, there is nobody who can question that because your motive was different, you shouldn't be given the deduction. So therefore, it is the totality of the circumstances which will rule the game. And one will have to keep in mind all of these principles that we have been discussing. Of course, business expediency or commercial expediency will be a very relevant test. But is it necessary? Necessary meaning, is it relevant for the business? Is it something which is having that benefit to the business directly or incidentally at least? So if it does not have a benefit to the business, then it is out of question. And in this context, we can always check the CSR expenditure. While we already have a provision which is not allowing you any deduction for CSR expenditure, the question is, was any expenditure which could have been treated as CSR expenditure, or which could have been treated as not directly connected to the business, but the expenditure is obviously with the purpose of expanding the business, with the purpose of meeting the objectives of the business. If that is the case, and in many CSR cases or in many activities which relate to CSR, there is an objective which is directly related to the business. Because when you're building or when you're incurring a CSR expenditure in a manner where the population around your factory is being or in a manner where you're creating something for the welfare of the population around your factory, you're ensuring that you get good employment from that population. You're also ensuring that there are news reporters who will give your name and say that, oh, he's a this corporate is a responsible corporate citizen, and so on and so forth, which will make you reap benefits from the business. And business purpose of business is very widely read by the courts, and you can always link those CSR expenditures with the business. Having said that, currently, CSR expenditure, which is referred to in the company law, is not allowed as deduction, as per the explanation which was added into the act a few years back when the CSR expenditure was brought in the company law. So now you will not be getting a deduction for that. So now coming to another condition, that it should not be capital in nature. Now, when these expenditures are incurred, this expenditure should not be in the capital field. Is very important. How do you test whether it is into the capital field or it is into the revenue field? And it is always the intention behind making that expenditure that will be relevant. So if today my intention of making a legal fees payment, and we are actually covering the next point as well, so I'm making a legal fee payment to a lawyer for discussing some expansion of business into a different city from where I am. So now when I'm discussing all of this with the lawyer, is this a capital expenditure or a revenue expenditure? Because I'm talking about a setting up, which is already decided that there is a setting up, and I'm into talks for the setting up purposes, it is into the capital field. When I'm only contemplating things, probably it is not in capital field, it is into the revenue field because it is for the purpose of business. So all of these will become very relevant as to the intention, the circumstances, the totality of the circumstances, as we mentioned here. Everything will become very relevant when you come to a conclusion whether it is capital in nature or it is revenue in nature. So what happens to expenditure on abandonment of a project? Now here, unfortunately, the courts are divided, and say consultancy expenditure, expenditure for the project report, legal expenses, all of these have been a matter of debate in the courts. And some of the courts have taken a view that the moment a project is abandoned, all this expenditure which you have accumulated should be treated as a 37(1) expenditure or the allowable expenditure. My personal view is a little different, not in all cases, but in cases where the expenditure was in the capital field, in cases where the expenditure was incurred not in the previous year but earlier. So, the question is, how can you get a deduction in the current year? It will become a prior period expense. So, all these points were not discussed in some of these decisions. Maybe the facts were different, therefore they were not relevant. But at least, if you are dealing with a fact pattern where you have an abandonment of a project, you will have to keep all of these in mind. Whether the expenditure was incurred earlier, not in the same as previous year, whether it was incurred in the capital field or it was incurred in the revenue field. Depending upon the facts, you will come to a conclusion, and then you will decide whether a deduction can be allowed in 37(1) or not. Legal expenses could be of various types, and every legal expense can't be allowed as deduction under 37(1). As I said, you will have to again apply the test as to whether your intention was to get a capital advantage out of it or to get a revenue advantage out of it. So it depends upon the facts of each case. So where you are entering into a contract of purchasing a plant and machinery, and you are paying the lawyer his fees for the purchase of the plant and machinery. That will be a cost towards the purchase of the plant and machinery. It should be added to the actual cost of the plant and machinery. It can go into the block, but it cannot go into 37(1) as a deduction technically. So when you're doing your tax audit, all of these questions will have to be kept in mind, or these items will have to be kept in mind. Now, what happens to lump sum payments? When they are made. So very typically, there are know-how payments, and know-how payments which are made as a lump sum payment for next 10 years. Whether you will be allowed as a deduction in the year of making the payment, or you will be allowed as a deduction in a staggered manner. Interestingly, there are a few Supreme Court decisions also. One of them, in the facts of the case before it, says that a lump sum payment also can be allowed as deduction in the same year of incurring it. In some cases, it says that it has to be staggered because it relates to those years, and therefore it should be staggered, and you need to uh, treat it as a deferred revenue expenditure. There is a problem in treating it as deferred revenue expenditure. Before I come to it, there are two Supreme Courts. One is Madras Industrial Investment Corporation, and the other is Taparia Tools. Both are Supreme Court decisions. And in both these cases, the courts have held differently. But Taparia Tools is the latter one, and it has taken into consideration the decision of Madras Industrial and gone into some distinguishing of facts and taken a different view. Basically, Madras Industrial says there has to be a matching principle. So, in that case, it was some different facts. But if you take a case where royalty payments are there, and you're paying royalty for a know-how for 10 years, then as per Madras Industrial, it has to be matching principle. So, 10 years, the entire lump sum amount has to be divided into 10 years, so that you are able to fulfill the matching principle. And what it says is that if you're doing an accounting in that fashion, then you can take a deduction also that way. Taparia tools is on a different footing, because in that case the expenditure is incurred on a discounted, uh, uh, net present value basis of the payments which would have been made for the next 5 years. So you're paying it today itself, and as per the scheme, it is incurred today. But then Taparia tools goes on a different tangent. It is discussing section 37(1)(3), interest payments, etc. Having said that, what do the technicals in this matter say? See, if you have to look at it very objectively, any lump sum payment or a periodic payment, why should it matter? If there is an expenditure which is incurred by the assessee from a revenue point of view, and you know that it is for the purpose of business, even if it's a lump sum payment, and you may derive some benefit in future as well, but it is not giving rise to an asset of an enduring nature, you have to give a deduction in the same year itself, in the year of incurrence itself. In fact, section 37 never gives you a leeway of claiming the deduction in any future year. At least the language of section 37 does not support any deferred revenue expenditure treatment. So yes, if somebody wants to apply a Supreme Court decision, which is a law of the land, he can apply, and probably he will not have have an issue. The only problem could be that if it's a longer period, then it will be difficult to go back to those years if the assessing officer does not allow you the deduction in the subsequent years. And in the subsequent years, it is very easy for him to say that this is a prior period expense, I will not allow you. So one has to exercise caution and then take a call on this front. We already discussed CSR expenditure. There's one more point which is relevant from section 80G versus section 37 point of view. Like even if something is, as I said, even if something is a CSR expenditure or something is an ATG expenditure, then we take it for granted that Section 37 does not apply to it at all. So, in a case where you're not treating it as a CSR expenditure and it is a general expenditure, which may still be eligible for ATG, you may have to evaluate whether 37 can apply or not. This we have discussed already, whether a loss is the same as what an expenditure is. So the thing is, both are conceptually different, and depending upon the facts, an expense may include losses, but not in all cases. Now coming to section 40, clause A, which is dealing with TT obligation related disallowances. What does this section or it basically, and not want to go into all the sections or the part of it. We may come to that later. It is basically saying that as a payer, if you are not fulfilling your obligation of deducting tax from certain payments, either to a non-resident or to a foreign company or to a resident, then there can be a disallowance. It also covers equalization levy deduction, and it also covers salary payments being made to non-residents. So when you are not fulfilling your obligation of either deducting the EL or the TDS in any other cases, you will have an implication under section 40A and different sub clauses of section 40A. Now these sub clauses, when do they come into picture? They come into picture when the TDS is not made, or when the payer does not deduct tax and just makes the payment to the relevant parties. So if the payer does not deduct tax, then also this section comes into picture. Secondly, if he deducts tax but does not make the payment of such tax on or before the date of filing of the returns, again he has a problem. In case of payments relating to in case of payments relating to residents, the the disallowance is to the extent of 30% of the payments. And if you make the payment before the filing of the return of income for that year, then you're allowed the deduction. For non-residents and foreign companies, or for equalization levy, or for salary, it is the entire amount. Now there is one more catch in this. Um, when there are payments made to non-residents or foreign companies, or residents, or ELs, uh, if in particular case, the SSE is paying, sorry, it's not EL, it is only the first two. If the SSE, what is happening is, if the recipient has already made the payment of the or made the payment of the tax and filed the return. If you see in 201, there is a proviso. The first proviso lays down certain conditions and says that the payer will not be an SSE in default if the following conditions are fulfilled by the recipient or by the payee in that particular case. So if the payee has filed the return, he has offered the income to tax, if he has made the payment of tax before the date of filing of the return, all of these conditions are fulfilled by the payee, then the payer is not treated as an SSE in default. He is only liable for interest on under 20. So in that case, 40A disallowance is reversed. And what is treated, or which date is relevant for 48 disallowance reversal purposes? The date of filing of return by the recipient. So the moment the recipient files the return, which is also very important. So when you are doing your tax audit or when you are filing the returns, you will need to check the past years where there has been a disallowance on these counts. And if there has been a disallowance on these counts, do check if the payee has already filed the return and made the payment of taxes. If he has done it, then the payer is not an assessee in default, and he may be absolved of this disallowance. You can reverse the disallowance in this year and consider it to be a part of your expense. So you can consider it to be a deduction allowable in the year in which the payee has filed the return. So the date of filing of the return by the payee is relevant for the purpose of this clause. Uh, Now, when you look at section 40A and 40 clause A and section 40A, so what is there in section 40 capital A? There are other disallowances. What are these disallowances? One is very common that we have all been facing is in the form of cash payments. So the payments which are not by way of account paycheck, not by electronic means, are or the ones which are in the form of cash are all getting covered. So we don't need to we don't need to cover that too much in detail. There are a couple of other things that are relevant to be just discussed. So one is transactions with related persons that are not at arm's length. Basically, this is not something for us to decide. Yes, what we will have to do is we'll have to report them in the tax audit report, which we anyway do. So the AO may come to a conclusion that these transactions were not at arm's length. So it will be very relevant and good to sound off the client about these payments, where the numbers are very high, and where as a matter of fact that these are not meeting the arm's length criteria. So you will need to sound off to the clients that these are the ones which are being reported in the tax audit report, and they could be subject to your scrutiny if the return comes in scrutiny. When you talk about rate or tax levied on business profits, it also includes surcharge. And as you know, a couple of years back, there was this issue which had erupted, and there were some taxpayers which were treating surcharge as not a part of rate or tax or cess. And since it was not part of rate or tax levied on the business profits, as per them, they said that surcharge is something which I will take as a deduction under 37. What? um, there was a problem with that argument, which I will come to. But the corporates or the taxpayers were taking that stand, and they were considering surcharge as a part of deductible expenditure. And they were taking a deduction for that, and then uh, there were a couple of high courts which also approved this. So what happened is under section 37 and read with 40A, they started rather under section 37 they started taking the deduction. Now there were these couple of high courts which approved the deduction, which is the reason an amendment came a couple of years back, where they said, look, nothing doing, surcharge is a part of rate or tax, and you cannot treat it as a deductible expenditure. Now let me tell you the basic premise on the basis of which the deduction was taken at that time was that they were not looking at the fundamentals of 37.1. Thus, do the conditions in 37.1 get fulfilled? Probably no, because the surcharge may not be treated as an expenditure for the purpose of business. It may not fit into those conditions which are laid down under 37.1 fully and exclusively for the purpose of business. It may not fit into that. But the SSEs were taking that, and ultimately the high courts have also agreed. But now there is an amendment, so you cannot take this stand. If there is any proposition by the taxpayer to take a deduction, please tell them there's an amendment. Now coming to the provision for gratuity, we don't need to discuss where there is a contribution to an approved gratuity fund, because that is allowable. The problem is only with the gratuity actually payable. What is the exact issue? The first issue is, number one, is it an expenditure under 37.1? Okay. Um, so while the employment is going on, does it fulfill the criteria of 37.1? Does it satisfy all the conditions in 37.1? The answer could be a yes, because of certain decisions, Supreme Court decisions, which have said that if there is a contingent liability and uh, based on, sorry, not a contingent liability, if there is a liability which is actually incurred, but only you are not able to quantify it. So if I am an employee of an organization, if I am an employee of an if I am an employee of an organization who has already crossed 5 years of service with the organization, that means the employer is obviously liable to pay the gratuity whenever I am leaving. So there is a liability which is incurred. The expenditure is incurred. Now, what is the liability? Nobody knows, because I might leave after 20 years from now, or I might leave in next 20 days. So you do not know what is the exact liability. Quantification is very difficult. How do you quantify? On the basis of actuarial valuation. So there were decisions, including the decision in the case of BML and all, where they said, okay, anything which is on the basis of actuarial liability, actuarial valuation will be allowed as deduction. So that should be allowed in 37(1). Now the question is, under 40A, is that gratuity allowable? The answer is no. It becomes allowable only in the year when it becomes payable. So only in the year when this gratuity becomes actually payable, you are allowed the deduction, not necessarily paid. So there are many people who confuse 40A(7) with 43B. Let us not confuse ourselves with 43B, because 43B is on actual payment basis. So let's say if an employee was to leave on 31st of March 2023, his actual complete settlement of his salary and everything would happen somewhere in the first week or the second week of April, generally, as a matter of practicality. In that case, what will happen? The actual payment of gratuity happens in the financial year 23-24. However, the gratuity became payable in the financial year 22-23. And it needs to be kept in mind that only the gratuity which becomes payable during the previous year is allowable. So actually the year of deduction should be financial year 22-23 in our example, and not 23-24 in the example where it was actually paid in 23-24. If it was a 43B expenditure, you would have said it is allowable in 23-24, because 43B is very clear, it is allowed on a payment basis, whereas 40A is allowable on a payable basis. One has to keep this distinction in mind, otherwise you will lose the benefit or the claim in the hands of the assessor. Coming to 43B, 43B has a list of payments or list of expenditures which are allowed only on a payment basis. Now it's very important, before we reach to this 43B, is that any payment or any expenditure which is covered in 43B has to be first allowable under 37. And sometimes, in our haste, we lose the sight of this condition, because anything which is an allowable expenditure can only be allowed on a payment basis. 43B is not giving rise to a new deduction, is what something which we have to keep in mind. So there could be payments to micro or small enterprises, for example, but those payments may not be allowable expenditures. There may be some illegal payments, let's say. If they are illegal payments, they will not be allowable as expenditure in 37(1) only. And if they are not allowable in 37(1), 43B is no provision to give you an extra deduction, or to absolve the problems of 37(1) and give you an additional deduction. So this will have to be kept in mind, and people will have to evaluate in each case whether it's actually a deduction allowable under 37(1). Only then it can have an allowability under 43B. So we know all of these components of 43B, and we need not go into the details of each of them. uh, One of them could be important, a couple of them could be important. Number one, the contribution by an employer to the provident fund or superannuation fund or gratuity fund. There used to be an argument by the taxpayers that this clause in 43B, it covers any contribution by the employer, whether it is a part of the employer's contribution or it is a part of the employee's contribution. And and it was being said that 43B allows me the deduction even if it relates to an employee contribution till the date of filing of the return, or sorry, or even beyond, uh, in the year in which I make the payment, I should be allowed the deduction. The answer is no. Employees' contribution is not covered under 43B, and now you have a specific amendment in 36(1), which is clearly not allowing the employee's contribution as a part of 43B, and it is clearly saying that 36(1) covers employee and 43B now covers only employer's contribution. So keep that in mind, because this was a very confusing matter all throughout until now, and that amendment is just made in 21, in 36, and until 21 2021 we were all taking the view that we wanted to take. Coming to your leave encashment in general shouldn't be any problem. Generally, it is allowable on an actuarial valuation basis and all. The problem comes, and even the problem comes in case of gratuity also, when there is a business transfer. And in case of a business transfer, one will have to be very careful as to whether there is a termination of the employment. You will have to ask the right questions to the client, whether there's a termination of the employment, how what are the terms of the leave encashment, what are the terms of terms as per the gratuity law, what are the conditions as per the gratuity law. All of these questions will become relevant before you come to a conclusion on uh, the allowability of these expenditures on a payment basis. Some of the issues, on 40A, 40 capital A, 43B, just we can discuss some of them. Section 40 has a language starting with notwithstanding, so it has a non-obstant clause. The section is not applicable. It is very clear. It does not apply at all if the expenditure was never allowable under 28 to 39. So we don't need to worry at all. So in many cases, the expenditure is not even allowed. And if the expenditure is not allowed, where is the question of disallowance? There is this point on 40 in 40A 1, 40AI, relating to payments to non-residents. It is actually quoting some specific expenditures: interest, royalty, fees for technical services, or other sums chargeable. When it says other sums chargeable, you have to import the meaning of it from section 195. And in the context of 195, your in the case of transmission corporation, the Supreme Court has already given a jurisprudence. So the meaning will also cover some part payments, and if the payment involves TDS on a part of it also, still it can be disallowed for the entire amount. The question is, 40AI versus section 201, which one applies or both apply? Answer is yes, both can apply. But there may not be a liability to deduct tax if the deductee has paid tax. And as we just discussed, if the deductee, meaning the payee, has already made the payment of tax and you are fulfilling the conditions in the proviso of section 201, then even 40AI disallowance is reversed. Reverse meaning reversed in that year in which the return is filed by the payee. Now, deduction can be claimed in more than one previous year. Uh, Not in all cases, only in case where the tax is paid in installments over a number of years. If the tax is paid in installments, you will get it on a payment basis. 40A IA disallowance not applicable to short deduction. Now, what is this? This is relating to residents. So, when you are making payments to residents, as I said, 30% of the amount which is paid to the residents will be disallowed if it is made without deduction of tax or without payment of the tax deducted. What if I don't appropriately deduct tax? So I have deducted tax at the rate of 2% instead of 10%. Can there be a, a disallowance in the first place? Answer is yes, because it is not in accordance with Chapter 17B. Number two, is it a short? If it is a short deduction, will you call it? Will you say that it will be allowable? Technically, answer is probably yes, but there is a Calcutta High Court which is in favor, saying that even if you are deducting short, it should still allow, and the disallowance should not happen. But one will have to evaluate in each particular case, and also keep the client into confidence, because the client might not want to go into a litigation from a deduction point of view, and therefore one needs to be really careful while taking these calls, or advising the clients to take these calls. From a 40A point of view, as I said, the incurs any expenditure has to take meaning from 37.1, and unless there is a 37.1, 40A will not come into picture. What happens to a gross amount of interest in 40AA? It will definitely not be the net after deduction of interest income, but it has to be a gross amount of interest. Meaning of the word sum in 40A obviously has to mean a sum of money and cannot be meaning the aggregate of total expenditure, and which I think Madras High Court has clarified. Coming to section 41, and this has been a section which has been a matter of debate for a very long time. and there was questions as to whether section 41 is a charge in itself, and whether it has an additional liability over and above section 28, and the courts have confirmed that it is an additional liability over and above section 28. It is clearly a charge which is an additional charge which is being levied even if there is no existence of business in that particular year. So what it says is, and let's read the bare text of it. Where an allowance or deduction has been made in the assessment for any year in respect of loss, expenditure, or trading liability. You're looking at this triangle where we have all the three items. One is trading liability, loss, expenditure. Trading liability incurred. So loss, expenditure, or trading liability incurred by the assessee. So it has to be incurred, and all of these words are very relevant, and subsequently during any previous year. So what is important is, number one, allowance or deduction has been made in an earlier year. So where you never made an allowance or deduction in any particular year, and then you are getting that money back, or there is a cessation of the liability. So let's say there was a payment on which you did not deduct tax. So the business did not deduct tax, and it was disallowed in 40AI. In the year, in the assessment year 18-19, that payment was made, but you did not deduct tax. Okay, and yeah, so there was no deduction for it. Now you realize that this payment was not supposed to be made only. Okay, and you're going to receive the money back. There is a cancellation of contract or whatever, you're receiving the money back in the financial year 22-23. What happens to that amount? Will it be taxable under section 41? Answer is no, because there was no allowance or deduction being made in any earlier year. So even if there is a remission or cessation of that liability, here it is not remission, it's a cessation of the liability. Even if there is a cessation of the liability or the expenditure, you still don't have to pay tax in 41 because it was never allowed as deduction. Now, what it says, whether or not the business exists, you have to make the payment of tax if there is a receipt of this kind which is stated in 41(1). Now, what is this kind of receipt? It basically says where the assessee has been allowed the reduction in respect of these items, whether when he obtains, whether in cash or in any other manner, any amount in respect of such loss or expenditure, or some benefit in respect of such trading liability by way of remission or cessation thereof. So if you are receiving some benefit out of any of these three items which were allowed as deduction earlier, then that will be deemed to be your profits and gains of the business in the year in which you receive it. Okay. The question is, what happens if a successor in the business is receiving the money? So business A Limited incurs the expenditure, gets a deduction for it. Then A Limited merges with B Limited and becomes AB Limited. So it's a new entity. Now AB Limited receives some benefit because of a cessation of this liability. What happens to this? Will AB Limited be subject to section 41? So before the amendment in section 41, we had a host of judicial precedents. One of them is Saraswati Industrial, which is a Supreme Court, which says that 41 will not apply because in case of an amalgamation, because the assessee, the word, the allowance was always attached to an assessee, and the taxability is also attached to the benefit received by the assessee. So if it is a benefit received by some other assessee, you cannot say that it is taxable in the hands of the other assessee, and that is the reason in the hands of the amalgamated company, in our example in the hands of AB Limited, section 41 was not applicable for the remission or cessation. There was an amendment after that, and now it has been made taxable in the hands of the assessee who has incurred it, or in the hands of the successor of the business. Now, there was another problem, which was, and we will discuss about this unilateral act in the sequent slide. So as I said, remission or cessation of liability in the very year, the remission or cessation in the very year, in the same year in which it is incurred, can also be taxed under section 28 in general, because that is the year in which you are allowed the deduction, that is the year in which it will be again taxable, and you will treat it as a receipt of the business. So this was Gujarat High Court. So remission and cessation has to be determined on the basis of operation of law. Operation of law means not just the Income Tax Act; it will be other laws, contract law, um, and other laws will be taking priority over there. And on that basis, you have to decide whether there is a remission. And if there is a remission or a cessation, then it will result into 41. Now the question is, where there is no remission, or where there is no remission means what? There is a closure of it in some fashion. Cessation means there is a termination of it in some fashion. What was being argued in a particular case is that there was a liability which became barred by limitation. There was no cessation. The other person who was to receive that money never said that, okay, I don't need the money. He did not give it. Neither he said that the expenditure was never supposed to be paid, or that money was never supposed to be paid. There was no cessation, no remission, but there was a bar by limitation. So the receiver's right or the creditor's right to ask for this money has gone by the operation of law. And the question was, can you say that there is a remission or cessation in this case for 41 purposes? And the Supreme Court said no, there is no remission or cessation. And when it is a liability barred by limitation, it should not be taxed under 41. After that, there was an amendment which was made in the law, and now, as per the amendment, anything which is a unilateral act of writing off of the liability can also lead to taxability. So, if in my own books as a debtor, I am writing off the liability, then it can result into a section 41 taxability. And I don't need to go by. So normally when a liability is barred by limitation, I will definitely write it off in the books, and my profits will increase accordingly. So the moment I write it off, that provision comes into picture. Explanation 1 comes into effect, or it gets triggered, and it will lead to uh, taxability under 41. Uh, as I said, amalgamation or demerger or a slum sale, all of them will be subject to tax as per section 41. Sorry, I just need a 10 seconds break for having water. Yes, coming to section 43A. Section 43 are sections which we just need to be, recapping for our familiarity, from our familiarity point of view. The issues in this do not need to be discussed because they are not very common in all cases. Very few cases are there where they face issues with these sections now because of the amendments and the clarifications after all of this. Uh, so when we look at section 43A, what it basically deals with, it deals with an increase or decrease in the actual liability to pay relating to an asset acquired in foreign exchange, and it has to be added to the cost or cost of acquisition of the asset. 43AA is actually saying that your ICDS will apply to any foreign exchange fluctuation or any gain or loss arising on account of the foreign exchange fluctuation. So ICDS, I think you have a session tomorrow specifically which will cover these receipts more in detail. Again, 43CA and 43CB are, so 43CA is the one where when there is a sale of land or building which is a stock in trade in nature, the consideration received, if it is lesser than the stamp duty valuation, then you have to replace it by the stamp duty valuation. Only if the stamp duty valuation is more than 110% of the consideration received. So you have a leeway of 10%, to the extent of 10%. If you have a gap between the stamp duty and the consideration actually received, there is no problem. But if you have a higher stamp duty valuation, it will be taxed. 43CB relates to construction contracts and service contracts, where the section now makes it mandatory to apply percentage of completion method basis. So even for service contracts which are related to chartered accountants, actually you have to follow the POCM method. and you will have to go by ICDS 3 and ICDS 4. This I think will need to be surely discussed in detail when you discuss the ICDS tomorrow. That's it from my side. Any questions? Happy to.
Bijal ma'am, we have a question from Ganesh. Whether expenditure allied to CSR activities like consulting fees paid to CSR consultant, traveling
Hmm.
expense, etc., allowed as a deduction?
Very strictly speaking, they may not be allowed as deduction. But if you are able to say that it was a part of some business activity where it was clubbed with other business activities, probably you will be able to take a deduction. But you will have to demonstrate the facts accordingly. Yeah. Any
Okay,
more
right.
questions?
As of now, mm, should we wait for 5 minutes? Like if we have enough time, and okay, there is one more question from Ritik. What if we have mentioned in the MOA that assessee can carry out leasing activity? Can we then show it under PGPP?
So this is a good question. It has been a matter of debate, whether rental income or income from leasing activities, can it be treated as business income or can it be treated as a house property income? Now you have Chennai properties, you have another Supreme Court which are conflicting with each other, and one says that it has to be treated as business income because leasing activity is a part of your regular business, and the other says that since you have a specific section in the form of house property, then you should offer this income even if it is your business to lease properties. You should still offer it to tax under section 22. I would say whatever is currently suiting you the best, you will have to apply the Supreme Court accordingly, the relevant Supreme Court accordingly. But yes, very important, you will have to check if your facts are more closer to that Supreme Court, which is taking the view which you want to take.
Okay, I guess okay, there is one more from Ritik. If we as a company provide freebie or hampers to our distributors, do we need to deduct TDS under section 194R?
So while we didn't want to have a session on 194R today, but yes, the question will remain in case of all these freebies and incentives being given to the distributors. As I
Okay.
said, you have to apply the tests. Number one, is it a benefit in the hands of the distributor? If you believe it is yes. If you believe it is arising from his business, if the answer is yes, you will have to deduct tax. And in any case, your circulars are covering it. So the answer is yes.
There is one more from Ritik. Hope it's okay. Like we can take questions, Bijal ma'am.
Yeah,
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 we
I'm
can
okay.
take up.
No problem.
Yeah.
Please
So
go
if we
ahead.
make gratuity provision as per actuarial report, and the same is never paid by the company as employees have never completed 5 years continuous service criteria, can we claim expense of gratuity provision?
No, no, you will never get the expense under 37(1).
It is just
You
a
will only get an expense in 40A7 when it becomes actually payable. So there will not be a situation of that kind ever.
Though as per accounting standard, it is not mandated to do the funding, but income tax, so it is definitely disallowed.
Correct. So you will definitely make a provision on an actuarial basis, but it is allowed under 40A7 as per actual payment, actually payable basis.
Yogita, the other questions you have covered, like there are total 11 questions, which
but
are 10 questions.
so yeah, so actually Chetan sir, I can view questions by not previously, so I can see just a second. There is one more question like Hitesh has question, but I can't see that question, so I have asked him to if
I'll,
he can.
no, no,
Yeah,
wait, I'll read. That's not a problem. I'll
yeah,
just
sure.
read it.
Thank you.
So Hitesh, the last 641 years posted a question: can a position be adopted that any tax paid in a foreign country should not be disallowed under Section 40A? This is because tax is referred in Section 40A should be the tax under income tax? Please share your views.
So the most important point, as I have been harping upon in this entire session, is that whether it is an allowable expenditure in 37(1) first, and then there could be a disallowance. So while we may want to evaluate if it is a tax as per 40A and whether it can be disallowed or no, in the first place, please make a conclusion whether it is an expenditure which is allowable as a expenditure wholly and exclusively incurred for the purposes of business. In most cases, you don't fulfill this condition.
There's a question of Ganesh that's on CSR, whether expenditure allied to CSR activities like consultancy fees paid to CSR consultant, traveling expenditure, etc., are allowed as a deduction.
This is discussed, Ketan bhai. I already
Discuss,
answered.
okay, fair. Whether we can have MOA is discussed. Then if company provides freebies, that is discussed.
Yeah, yeah.
Yeah, we covered that and subsequent as well. Yeah.
Fair. I think then almost we have covered everything.
Okay. So, okay, then we can conclude this
Loan
entire.
wala. Will the loan
Achha,
waiver of loan be allowed as an expenditure?
achha, okay.
That is covered.
So we no, it's not covered, Ketan bhai.
So the
So
question
I
is,
understand.
will the waiver of loan be allowed as a deduction of expenditure in the hands of the lender?
Yeah. So where the lender is in the business of obtaining and giving loans, and when you are waiving of a loan, it should be allowed naturally because it's an expenditure in the course of the business. Bad debts and all of that will be a part of it. So when you are waiving it, it may generally form part of the bad debts. If it is not forming part of the bad debts, generally you will need to demonstrate that the waiver was for some commercial expediency reasons, or there was some commercial expediency involved in it. And generally waiver is allowed if there is a reasonable cause, and in most cases there is a reasonable cause unless it's a group company. So if you have a reasonable cause to waive that liability, which is obviously having some connection with the commerce or some connection with your business, you will be allowed a deduction even if it is a normal receivable. You know, you're supposed to receive some money from a debtor and you're waiving it off. You're waiving it off only for the reason that you want to maintain the relationship with the debtor. Still, it should be allowed. You have a jurisprudence on that. There are some decisions which are in favor.
Vishal, that question of cooperative society was asked.
Now,
Okay, so there is one more question of Hitesh, which says that whether any income or loss as per the income and expenditure of a cooperative society be offered under the head of PGBP or income from other sources. And he says, just for reference, under the GST law, CHS are deemed to be carrying on the business.
I'm sorry, I'm not an expert on
I'll,
actually cooperative society related, assessees or taxpayers, and I've hardly dealt with any cooperative society as a taxpayer. So sorry, I
so
may not be
normally,
the.
what I have been seeing is that it is taken as other sources and ATP,
Yes,
when you are claiming.
yes,
So, you claim that as an interest. So, and generally, the following the concept of mutuality, the other item which are not taxable are not
hmm,
offered for tax, and only, interest income is offered. And there, again, wherever ATP is allowable, that is claim. It is not allowable nowadays. That amendment has also come. So, the balance amount is taxable.
hmm.
I think we've covered everything.
Yeah. We can conclude the session then, Ketan sir.
Perfect. I request Yogita to propose a very well-deserved vote of thanks for Bijal madam.
Yeah. So, thank you everyone for your great participation. We would like to thank Arpit Kabra sir for arranging this session, and also CA Ketan Saria, Treasurer, for arranging the wonderful session, and Bijal ma'am for imparting such a great knowledge and sharing her experience, live experience, what she is actually having from her so many years with the entire attendees and participants today. I hope it will be really helpful for everyone. Thank you so much. Yeah.
Thank you. Thank you,
Thank you
Bijal.
so much.
Thank you,
It was a
ma'am.
great pleasure.